Let's just get straight to it. Copper could face a major global shortage by 2040 and production's about to peak around 2030. Now, this isn't just about metal. Copper is inside electric vehicles, power grid, renewable energy, data centers, and even your home wiring. If supply peaks while demand keeps rising, this doesn't just affect traders, it affects the global economy. Let's break down what this actually means from a bullish and a bearish standpoint and how we can actually make money from this situation. Sit back, relax, and plug in. So have a look at the screen here and we could see what was announced. S&P Global, they basically predict and they project that global copper production could peak around 2030, but demand is expected to continue throughout 2040 and beyond. That gap between supply and demand is where the problem starts. When supply peaks but demand accelerates, price don't just move, they structurally reprice. Now what I'm bringing to you here, this isn't just no short-term headline news. This is a 10 to 20 year macro story. Now some of you might be saying, okay, why does copper matter? Break it down. Now let me break it down to you. The reason why it matters is because its demand reflects economic health. Now let's actually think about what copper is used in. It's used in EVs, electric vehicles. It's used in solar panel, wind turbines, AI data center, in a lot of things. Now I'm going to show you something and I'm going to break this down very simple. A normal petrol car uses around 20 to 25 kgs of copper. Now an electric vehicle uses around 80 kgs. That's roughly 3 to 4x more. Now think about it like this. If we think that governments worldwide are going to be pushing for EV adoption, then we could kind of see the play here already. And the play is many EVs are going to be hitting the road, and that means copper demand will go up. And now that's even before we even talk about the other part of electric vehicles, the charging infrastructure that needs copper, the grid upgrade that needs copper, battery storage that needs copper. This isn't just about cars, it's about rebuilding the entire energy system. Now I hope you're listening because this is where it gets real interesting. Now copper mines aren't like factories, so let's just park that off right there. They're not like factories. You can't just turn up production like you can in a normal factory. To open a new copper mine, it takes 10 to 15 years. It takes billions in capital. It takes environmental approvals, and there's also political risk. So you've guessed it, you can see why there can actually be a supply issue here. And this supply issue becomes even more bigger because some analysts project that by 2035 to 2040, global copper demand could double, but supply growth is nowhere near the pace of that. So if the gap actually widens, price doesn't just go up, they spike. And we've seen this happen before. When supply is tight and demand explodes, price doesn't just behave calmly. So now let's actually see why this matters to investors. It's time to actually get in the bag and actually see how we can actually make money from this. Now the play is quite simple. If copper demand rises over the next 10 to 20 years, where does the capital flow into? You've probably guessed it. It goes into copper miners, commodity ETFs, emerging market producers, green energy stocks. This isn't just, oh, I've got a trade next week that could probably work. This is a structural macro theme, and those are the biggest moves in the market. Now let me break down the bullish case and the bearish case. The bullish case is simple. If supply peaks and demand continues to grow from EVs, green energy and infrastructure, copper prices will just go up over the next decade. It's as simple as that. And that will benefit copper miners, commodity ETFs and all other indexes that track copper. But here's the bearish case. If the global growth actually slows down, then the projection that we're looking at could fall. So this isn't 100% guaranteed. if you're an investor, this isn't about panic. This is about positioning. So this is the way we can actually make some money from this situation. We've got copper ETFs, we've got mining stocks, and we've got different diversified commodity funds that we can actually put our money into if we actually think that this play is going to plan out. It's as simple as that. It's not confusing. And the reason why a lot of people find this stuff confusing is because in school, this isn't the stuff they was teaching us. Now, here are 3 funds that you can actually put your money into if you think that this play is going to plan out. The first one is the United States Copper Index Fund. The ticker symbol is CPER. So if you go onto your broker account, you just type that in, and that basically tracks copper future prices. It gives direct exposure to the copper price movement. If you want pure copper price exposure, this is the cleanest retail option. The next one up is Global X Copper Miners ETFs. So that's COPX, that's the ticker symbol, and that basically holds global copper mining companies. It basically gives you indirect exposure to copper. It has a higher upside potential, and that's basically best for long-term investors. And last but not least, broader metals ETFs. That's basically indirect exposure, and there's 2. You've got the iShares MSCI Global Metals, and then you've got the SPDR and SP Metals Mining ETFs. So these basically include copper, but they also include other metals like iron, steel, aluminium, and etc. Or you could spread your investment and cover all 3 or even 2. So let's wrap this up. Plain and simple, is copper running out? No, not exactly. It's not running out. But production peaking while demand rises, that's something that the market is not going to ignore. And this could be one of the most defining commodity story for the next decade. So we all understand this now. We're not reacting. We're basically just preparing ourselves. If this was interesting to you, like, subscribe, comment. I'm going to be putting out more videos about different type of plays. And yeah, we're going to get to it.